Welcome to this presentation on PACE financing for commercial real estate companies. My name is George Caragior, Senior Fellow with PACE Now. Today's presentation is entitled, Why Should Property Owners Use PACE? The purpose of this presentation is to clearly describe the many benefits of PACE financing for real estate companies and to provide examples of the financial impact of PACE on the various lease forms. After your review of this information, you will understand how PACE can increase a property's EBITDA by enabling projects that would otherwise not get done using a company's internal capital. For property owners, the reasons for using PACE is clear. Using PACE to finance energy efficiency, renewable energy, or water conservation projects lowers a property's operating costs, which increases EBITDA and in turn increases the property's value. That's the bottom line. PACE increases a property's value. Over the next few slides, you will see that PACE clearly provides one or more benefits to property owners under all lease types. These include increasing NOI and EBITDA, increasing property value, improving aging infrastructure with no residual encumbrances upon the sale of a property, aligning landlord and tenant interests, increasing cost recovery, and enabling sustainable development. One of the keys to PACE financing is its secure nature. By secure, I mean that the investors who provide the capital required to finance sustainability projects through PACE are confident that they will get their money back, including profit. Let's see why. First, property owners who use PACE to finance sustainability projects pay for them through an annual assessment on their property tax bill. Because property tax assessments are automatically secured by a lien on a property, owners don't monkey around when it comes to paying the tax bill. Second, it's important to note that the PACE line item on a property tax bill typically has the same standing as any other line item on the tax bill. Indeed, property owners don't have the choice to say, okay, I'll pay for the school tax line item, but not for that other one. When taxes are paid, the PACE assessment is paid. Finally, the annual PACE assessment, like any other line item on the property tax bill, is senior to any other obligation, including the mortgage. In the event of a foreclosure, tax obligations are first in line to get paid. This secure nature of PACE means that investors are willing to provide financing for up to 20 years versus typically no more than 7 to 10 years for bank financing of sustainability projects. The longer amortization period available for PACE financing translates into a lower annual assessment. Practically speaking, PACE financing with a 20-year term means that projects with simple paybacks as long as 12 years can still be implemented on a positive cash flow basis. And by that I mean that the energy savings will exceed the annual PACE assessment. I will provide an example of this in a few minutes. The positive cash flow resulting from a sustainability project financed through PACE, that is, the savings generated by the project minus the cost of the annual PACE assessment, means increased net operating income. For commercial property owners, every dollar in increased NOI, applying the appropriate cap rate, increases the property value by up to $20. At a 5% cap rate, for example, a $10,000 increase in NOI translates to an increase of $2 million in property value. The increases in NOI and property value is a big reason why PACE makes so much sense for real estate companies. Just as important, however, is the fact that PACE assessments are linked to the property and automatically transferred to a new owner upon sale, like any other real estate tax. This automatic transfer upon sale is a really important benefit of PACE financing. With PACE, the new owner takes on the payment of the assessment, while enjoying the benefit of the sustainability project that was financed by PAYS. Normally, owners are reluctant to invest in CapEx if they are not sure to retain a property for the long term, especially if they are unsure of their ability to recover their investment in the sale price. PAYS simply removes this so-called holding period bias, which often prevents investments in sustainability or much-needed CapEx projects. In addition to taking away the risk of investing in CapEx, PAYS creates no residual encumbrances upon the sale of a property. With typical bank financing, if the bank did not feel comfortable with the buyer's credit worthiness, the seller would have to pay off any energy efficiency loan or guarantee the new owner's performance. PAYS, however, runs with the land, like any other real estate tax, and transfers automatically to a new owner upon sale, regardless of the new owner's credit. One unique benefit of PAYS financing is that the resulting real estate tax assessment, along with the cost savings generated by sustainability projects, can be shared with the tenants upon most lease forms. This means that PAYS actually improves the economics of sustainability projects. When using corporate capital under triple net leases, for example, the reduction in the cost of energy in the landlord account is offset by reduced recovery of this cost from the tenants. All energy efficiency savings generated from investments by the landlord in a common area go directly to the tenant's bottom line. For the landlord, the cash-on-cash return is negative, which is a big no-no for any CEO or CFO. This so-called split incentive, the investment is made by the landlord, but the benefits are enjoyed by the tenants, is a reason why so few sustainability projects are undertaken by landlords at properties with triple net and modified gross leases. When using PAYS capital under triple net leases, however, the reduction in the cost of energy in the landlord account is also offset by reduced recovery of this cost from the tenant. At the same time, however, the increase in the cost of real estate taxes is offset by the recovery of this cost from the tenant. For the landlord, the effect on EBITDA is neutral, and the asset is improved without any use of corporate capital. At the same time, tenants' EBITDA can be increased by selecting the proper tenure for PAYS financing. Indeed, by selecting the appropriate term for the PAYS financing, the energy savings enjoyed by the tenants will exceed the annual PAYS assessment. PAYS is unique in its ability to provide a win-win solution for landlords and tenants. To help you get a better appreciation of the financial impact of PAYS, let's use a realistic example of an energy efficiency project presented for internal approval by commercial real estate executives. While many lighting retrofits have a simple payback of 3 years or so, the payback in this example is much longer because of the required investment in additional lighting poles in the parking lot to provide a safer environment for tenants, employees, and shoppers. This scenario is typical. There are exceptions to every rule, but my bet is that with a payback of 6.1 years, this project would not pass muster with executives. Unless the need to improve the lighting quality of the property was incontrovertible, corporate funds would not be allocated to this project simply on the basis of the energy savings generated. Whether your corporation imposes a 3-year simple payback test on your sustainability projects, or 4, or even 5, the reality is that many sustainability investments presented for approval are simply turned down by senior management because they do not meet the investment hurdle rate that is required for the use of internal funds. So with that in mind, let's look at the financial impact on the company's bottom line if this project were to be funded through PAYS. Let's first look at the financial impact of the project at a property where the form lease is a gross lease. Gross leases are typical for industrial facilities. You can also think of hotels and multifamily properties as having a form of gross lease. With gross leases, the landlord is responsible for all costs in the common area. In the example we are looking at, unless the lighting levels in a parking lot were so horrible as to demand immediate action to avoid liability claims or to keep the property competitive in the marketplace, the landlord would typically evaluate the project against its hurdle rate requirements for the use of internal capital. The financial impact of our example project under a gross lease scenario is as follows. With a 6.1 year simple payback, this project would generate an internal rate of return of 13.4% over 10 years using corporate funds. At a cap rate of 6%, the project would increase the property's value by over $500,000, but only if internal funds were used to fund it. However, with a required investment of $200,000 and energy savings of only $33,000 annually, it is very unlikely that senior management would approve the use of internal capital to fund this project. A simple payback of 6.1 years is simply seen as too long to merit capital allocation. PAYS financing, on the other hand, makes the investment compelling. Over 10 years, and using a discount rate of 8%, the present value of the cash flow generated by the project is almost 3 times greater than what it would be with the use of internal capital. The net savings generated by the project, after paying the increased real estate tax assessment, would be significant and generate an increase in property value of approximately $250,000. All that with absolutely no investment required by the property owner. In this gross lease example, the reality is a choice between not doing the project or doing it with PAYS and increasing the property's value. Let's look at the financial impact of our example project at a property where the form lease is a triple net lease. Triple net leases and the somewhat similar modified gross leases are typical at the office buildings. They are also extensively used at retail real estate properties. Under triple net leases, real estate taxes, building insurance, and common area repair and maintenance expenses are passed on to the tenants. Under triple net leases, all the benefits of a sustainability project flow to the tenant's bottom line while the investment is made by the landlord. This so-called split incentive is the reason why the landlord would not implement our example project, unless the lighting levels in the parking lot were so horrible as to demand immediate action to avoid liability claims or to keep the property competitive in the marketplace. The financial impact of our project under a triple net lease scenario is as follows. As discussed earlier, the use of internal funds to implement a sustainability project under a triple net lease is extremely unlikely, except when the project is essential to keep the property running. As you can see in the table above, although EBITDA would not be affected by the project, the cash-on-cash return would be negative, with all the benefits accruing to the tenants. With PAYS financing, however, the real estate tax assessment, along with the cost savings generated by the sustainability project, can be shared with the tenants under a triple net lease. As noted in the table, the reduction in the cost of energy in the landlord account is offset by reduced recovery of this cost from the tenant. At the same time, however, the increase in the cost of real estate taxes is offset by the recovery of this cost from the tenant. The effect on EBITDA is neutral for the landlord. On the other hand, tenant's EBITDA is increased in this example thanks to the use of a 20-year PAYS financing term. An 8-year PAYS financing term would leave the tenant neutral from an EBITDA point of view. In addition, the asset is improved without any use of corporate capital. In this triple net lease example, PAYS helps improve the asset with no capital investment by the landlord and lowers costs for the tenants. In summary, the use of PAYS financing by real estate owners can provide many benefits, including increasing NOI and EBITDA, increasing property value, improving aging infrastructure with no residual encumbrances upon the sale of a property, aligning landlord and tenant interests, increasing cost recovery, and enabling sustainable development. So the next time a real estate executive asks you why he or she should use PACE financing, just pull out this presentation. Informed real estate owners will conclude that they should always consider PACE financing when making a sustainability investment decision. Thank you.